Credit card companies make it easy to swipe, but behind the convenience lies a hidden trap. High interest rates, late fees, and minimum payments are designed to keep you in debt for years, paying far more than you borrowed. What feels like financial freedom often turns into a cycle that's hard to escape. In this video, we'll break down exactly how banks profit from your credit card debt and what you can do to avoid falling into their trap. So before we start, make sure to hit the like button and subscribe to my channel. The deceptive lure of minimum payments. The shimmering promise of a credit card, the ability to purchase what you need when you need it, and to build a strong financial future, is a powerful one. It's a key part of the modern financial landscape, a tool for convenience and a lifeline in emergencies. Yet for millions of individuals, this seemingly harmless plastic card transforms into a financial ball and chain, a relentless source of stress, and an insidious trap. The credit card debt trap is not an accidental byproduct of consumer behavior. It is a meticulously engineered system, a business model perfected by banks to ensure that a significant portion of their customers remains perpetually indebted. This article will delve into the intricate mechanics of this trap, exposing the deceptive practices, predatory tactics, and psychological manipulations that banks employ to keep you stuck in a cycle of debt. The minimum payment trap. The foundation of the credit card debt trap lies in the alluring yet deceptive concept of minimum payments. When you receive your monthly statement, the most prominent number is often the minimum amount you need to pay to avoid late fees and a hit to your credit score. This number is deceptively small, often just 1 to 3% of your outstanding balance. It's designed to seem manageable, to give the illusion of progress, and to encourage a sense of security. The psychological trick is simple. A large, intimidating number like a $5,000 balance can feel overwhelming, but a $100 minimum payment feels achievable. What banks don't highlight is that making only the minimum payment ensures you are paying almost exclusively interest, with very little of your payment going towards the principal balance. This is the cornerstone of the debt trap. A small, manageable payment keeps your account current while allowing the principal to stagnate, enabling the high interest rates to compound and balloon the total debt over time. The bank benefits from this arrangement, as they continue to collect a steady stream of interest payments for years, sometimes even decades, on a debt that was incurred in a matter of months. The reality of interest rates. Beyond the minimum payment illusion, banks employ a sophisticated array of interest rate tactics that make escaping debt feel like an impossible task. The most common and insidious of these is the variable interest rate. Most credit cards are issued with an interest rate that is not fixed, but is instead tied to a benchmark like the prime rate. This means that as the Federal Reserve raises interest rates to combat inflation, your credit card interest rate automatically rises, sometimes without you even noticing. What was a 17% APR can quietly creep up to 21% or more, making your debt even more expensive to service. Furthermore, banks often use introductory 0% APR offers as a powerful bait and switch. These offers are incredibly tempting, promising a period of interest-free spending. However, the fine print often reveals that if you miss a single payment or fail to pay off the entire balance before the promotional period ends, you are hit with a deferred interest charge. This means that interest is retroactively applied to the entire original balance, as if the 0% APR never existed. The obscure language of legal contracts. The credit card agreement itself is a masterclass in obfuscation and legal jargon, a deliberately complex document that few customers ever fully read or understand. Buried within the fine print are clauses that give banks immense power and flexibility in how they manage your account. One of the most critical is the Universal Default Clause, which, while less common today due to regulations, still lingers in many contracts and practices. This clause allowed a bank to raise the interest rate on your credit card not because you were late on that specific card, but because you were late on a loan or credit card with a completely different company. This practice, in effect, punished you for a transgression on a separate account, raising the cost of your credit with an unrelated institution. While the Card Act of 2009 limited this practice, banks have found other ways to achieve similar results, such as repricing your interest rate for reasons that are often vaguely defined in the contract. Rewards and credit limits. Credit card companies are also masters of psychological manipulation, using a variety of subtle cues and reward systems to encourage spending and discourage paying down debt. The very design of the credit card reward system, points, miles, and cashback, is a powerful incentive to use the card for every purchase, large or small. It creates the illusion that you are getting a free benefit, a return on your spending. However, for a user with a balance, the interest they pay far outweighs the value of any reward. A cardholder with a 20% APR who earns 2% cashback is still losing money hand over fist. Furthermore, the credit limit itself is a psychological anchor. When a bank raises your credit limit, it's not a gift. It's an invitation to spend more. This is often framed as a sign of your excellent credit and financial health. But for someone already struggling with debt, it's a dangerous temptation. Predatory lending. The targeting of vulnerable populations is another core component of the credit card debt trap. Banks use sophisticated data analytics to identify individuals who are most likely to carry a balance and pay high interest. This includes young people with no credit history, individuals with low to moderate incomes, and those who have recently experienced a financial setback. These are the very individuals for whom a small debt can quickly become an insurmountable burden. They are offered attractive-looking cards with high interest rates and low credit limits that quickly become maxed out. Subprime credit cards, in particular, are a ruthless example of this. These cards are specifically designed for individuals with poor credit and come with exorbitant interest rates, annual fees, and other charges that make them incredibly difficult to manage. The business model of these cards is not to help people rebuild their credit, but to profit from their financial distress. The hidden trap of payment allocation. Even when a consumer attempts to pay down their debt, banks often employ opaque payment allocation methods that work against them. For many credit cards, a payment is first applied to the balance with the lowest interest rate, such as a promotional 0% APR balance or a cash advance, and only then is it applied to the high-interest purchases. This is known as payment allocation, and it is often done in a way that maximizes the interest the bank collects. This is a subtle but powerful tactic. A cardholder who makes a payment thinking it will reduce their most expensive debt is often surprised to find that the high-interest balance remains largely untouched, while the low-interest balance is paid off. Beyond financial loss. Finally, the long-term consequences of the credit card debt trap extend far beyond financial hardship. The constant stress of debt, the endless cycle of payments, and the fear of falling behind can take a significant toll on an individual's mental and physical health. It can lead to anxiety, depression, and a feeling of being perpetually stuck. The damage to a person's credit score from missed payments or high utilization can lock them out of future opportunities, making it difficult to secure a mortgage, a car loan, or even a job. This creates a self-perpetuating cycle of financial instability, where a person is unable to escape the very system that has trapped them. The credit card debt trap is a complex, multi-layered system designed to profit from human behavior and financial vulnerability. It is a testament to the power of a business model that is built not on providing a service, but on ensuring a continuous flow of interest payments from those who can least afford it. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.